In this video, we're going to have a look at SL Green Realty Co, ticker symbol SLG. SL Green is a real estate investment trust, also known as the abbreviated REIT. They state that they are Manhattan's largest office landlord. They primarily acquire and manage commercial properties. As of September 30th, 2023, the company held interest in 59 buildings, totaling 32.5 million square feet. SL Green showcase all their properties on their website, so you can see exactly what you're investing into if you decide to take the plunge. It also lists the availabilities. The stock is at a 52-week high of $44.65 and low of $19.05. This low was in March and it has more than doubled in price since then. If we zoom out over 5 years, the stock price was over $100 pre-pandemic. It recovered up to just over $80, then started a sharp descent in April 2022. Even though the stock price has doubled this year, it needs to double again to reach the heights of nearly 2 years ago. If we zoom out even further, stock price has been in a steady decline. Throughout this time, if you were a shareholder, you would have collected dividends, but has the return been worth it? If we look at the dividend history, they've been paying dividends since May 1997, starting at 16 cents, then regular increases all the way up to the financial crash in 2008. They then understandably cut the dividend down to 10 cents. From there we can see regular increases all the way up to 88 cents before changing from quarterly payments to monthly around the time of the pandemic, starting at 29 cents. They then have had increases but have had to cut twice in the past year. The cut for the financial crash is understandable. They want to protect the business and make sure they have enough cash flow to get through it. The reason behind the dividend cuts was that SL Green could match its estimation at the time of the funds available for distribution for 2023. The dividend yield is currently 7.7%. Compound annual growth rate over the trailing 12 months has been minus 12.52%, minus 12.4% over 3 years, and minus 0.92% over 5 years. For REITs to work out if they can cover the dividend, it is better to use the adjusted funds from operations, abbreviated as AFFO, rather than the payout ratio, as this provides a true reflection of their finances. Looking at Seeking Alpha, it is currently 89.42%. This may seem high, but this is normal practice, as it's required for REITs to pay 90% of their taxable income to unit holders. Now let's look at the finances. SL Green has a market cap of $2.85 billion. Looking at the recent quarter, revenue is down by 18.47% from the previous quarter. It needs a strong quarter to top 2022 to see continued growth. If we check against previous years, revenue has been declining. 2022 has seen it move up. The next quarter will determine if it can keep that momentum. On the balance sheet, SL Green has seen a continued decrease of their total assets in the last 4 quarters. Looking at the overview, overall fairly underwhelming. Net debt has been reducing over the quarters though. Let's have a quick look at how it's performed against the S&P. If you'd invested $10,000 10 years ago and reinvested the dividends, you would have a total return of minus 27.43%, ending with a value investment of $7,260. Out of all the checks I've done with previous stocks, this has been the worst return. The S&P would have given you 206.47% return, with $30,654. Let's be fair and look over the past 20 years. The return is much better with 131%, ending with a value of $23,000. The S&P dwarfed this though with 517% return. Let's see what the analysts are forecasting. Market beat have an average price target of $33.56, which is minus 20.47% downside from where we are today based on 16 analysts. Tip ranks have an average price target of $35.73, which is 15.73% downside based on 11. And Zacks have an average buy price of $33.13, which is minus 17.59% downside from where we are today based on 15. From the targets and market beat, Tip ranks and Zacks, an average price between the three is $34.14. If we have a look at the intrinsic value calculation based on the discounted cash flow model, is a fair price of $31.53, which is minus 25.3% downside. If we take the analyst expectations and the investing model, that would give us $32.83 with a 10% margin of safety. that will give us a buy price of $29.54. It may be okay as a very, very long-term investment, as prime real estate will always go up in value. I don't have any shares of SLG, and I wouldn't personally be looking to buy any. There are far too many better REIT options. As usual, thanks for watching. If you've enjoyed the video, please like and subscribe.